on your journey to become a master trader. So the term technical analysis seems to be different for every type of trader I talk to. The minute you say technical analysis, it seems to be lots of traders automatically jump over to what we call technical indicators, oscillators, and indicators that are mathematical formulas. But that's only one tiny field of study in a great big field called technical analysis. Now, if you want to use the technical definition, technical analysis is the study of price movement on a financial chart. We can think of technical analysis as a sort of framework that traders use to study and make use of price movements in the market. I like to take the word technical analysis and throw it in the trash. And I like to rename it chart analysis, because basically technical analysis is anything and everything we do on a price chart. Simply looking at a price chart is technical analysis. Drawing a trend line on a price chart is technical analysis. Drawing a little circle and a squiggly on a price chart is technical analysis. Looking for patterns like triangles is technical analysis. Using technical indicators or wave theory or cycles is all technical analysis. Now, technical analysis focuses exclusively on the study of price charts and trading history to determine the future price movements. So as I said, I call technical analysis chart analysis. Technical analysis is anything you do on your price chart. Now, the primary reason that we use technical analysis is to make predictions about future price movement based on past price movement. Now, my theory or my philosophy is that price is completely random. And price is the only thing that dictates what's happening in the market. Now, price is made up of human beings around the world, millions and millions of people trading an asset, making decisions. Well, if you're using human nature, human psychology, and you're using human beings, how can we use these indicators or these charts to make sense of the markets? Well, again, if you go back to my theory that the markets are completely random, price is completely random. But there are certain times that price starts to move in a non-random fashion. And when this happens, we can then apply some sort of chart analysis to figure out what price is going to do while it is moving in that particular non-random movements. Now, I don't want to discount fundamental analysis. Okay, fundamental analysis is reading the news, is looking at economic events. These have certain momentary effects on the market, and it can have an effect on a longer term value of an asset. But it really doesn't help us in trading, because if I tell you that Google's introducing a new Google Watch that the world is going crazy for and is selling like crazy, okay, well, that would tell us, if we read that headline news, that Google prices should be going through the ceiling. Or say Apple prices should be going through the ceiling, or Facebook. Okay. Fact is, if I were to tell you that Google's selling at 149.25, it was at 148.72 and went up to 149.92 and came back down to 147.48 before it went back to 149.97. Could you make any sense of that? Could you figure out if Google price actually has gone up? If Google price is moving in response to that news? No. You can only do that by looking at a price chart. And that is technical analysis. So technical analysts look for patterns on charts that tend to repeat themselves. They do this to develop their trading edge. The underlying logic here is that price and price movement is driven by human beings. Certain patterns will repeat themselves in the market as human beings tend to be repetitive in their emotion and their interaction. Technical analysis also encompasses learning to analyze the market structure, find trends, support and resistance levels, and generally learn to read the ebbs and flows of the market. There's obviously discretion involved here. And I will be the first person to tell you that technical analysis is more of an art than it is a science. Okay? For the big name and the big explanation and the big definitions of technical analysis, it sounds like it's all a field of science, but it isn't. It's art. And that's why all of us can interpret these indicators, these oscillators, these patterns, these trend lines differently. Okay? And by being the artist who gets to know all the fine ins and outs of a particular asset and how the price movements are, and seeing and visualizing this on a chart makes you better than the guy down the hall. So using a chart and using technical analysis makes you interact with the asset that you're looking at. So that said, it's something you will get more comfortable with and better at given time and practice. Technical analysis forms the backbone of my core trading method of price action, which is simply a derivative or an offshoot of traditional technical analysis, except with more clarity and more concise strategies that don't involve confusing indicators and things like Elliott wave patterns. Now, if you want to learn to master Elliott wave theory and you want to learn to master cycles, there's nothing wrong with it. Okay, don't misunderstand me. But that's where you start to get really complex. Okay, and it doesn't really help most online CFD and Forex traders because we're looking at short-term markets. And with Elliott waves and cycles, we have to be able to look at the larger market, then a smaller, and we have to judge environmental. They will help you if you were looking to invest over a longer period of time, or maybe even if you were a swing trader. But it doesn't really help us in our short term, but they're very valuable. But the theories are too messy and open to interpretation for me to believe that they're really worth trading or teaching. So I come down to the fact I believe in being able to look at a chart and interpret what the chart is trying to tell us using technical analysis. Now, again, like I said, technical analysis is a study of everything that we do with a chart. So Elliott waves, Gann fans, Fibonacci's, support and resistance, trend lines, RSI, stochastics, MACD are all part of the study of technical analysis. Let me pop up a live chart here for us. Okay. Now, one of the fields of study on technical analysis is, we can call it market structure. It's better known as chart patterns. These are patterns that appear to us in daily trading systems. Okay. They appear in all assets. My favorite is the triangle, but we have everything from head and shoulders to cup and saucers to pennants to flags, but they are patterns. And these patterns repeat over and over and over and over again. So therefore, we can take a look at them and then apply some rationale to using them. And they are one of the biggest fields of technical analysis. They give us, almost every trader I know uses some sort of pattern recognition, whether we're looking at channels, whether we're looking at double tops and double bottoms. Okay. Everybody uses them. Okay. So this is one of the biggest fields of study. But when you say technical analysis, people don't jump over to chart pattern. They jump right to technical indicators. Now, we can actually combine these types of studies together, like we see here. And this is a combination of technical analysis. Here we're using a triangle pattern, which is a chart pattern. We're using support and resistance zones. These are the floors above and below price, like an elevator. Support is what's supporting your feet, and the ceiling is being held down by your head. And we're also using, in this case, MACD, which is a technical indicator. And together we are using these to determine where we expect price to go. We're using this to determine where we would put our target, where we would set our stop loss, and where we would consider entering the market. We do all that so that we can calculate our risk management, because ultimately, no matter what you're doing, risk management and understanding your risk is what is vitally important. But as you notice, all of this is done on a chart. So hence we go back to chart analysis. Uh-oh. So most traders instantly think of a price chart like the one that we just looked at when someone mentions the word technical analysis. Price charts provide us with an amazing amount of useful data that paints a complete picture of a market's historical and current supply and demand situation, as well as the price levels that the market participants have deemed the most important. Now, before I go on, I forgot to mention to you, number one, I gave you a link in your chat window. That'll take you to a special offer from FBS. Also, if you look on your screen, there's a little box that says handouts. And I put together two handouts for you. One is the technical indicator guide. This is a guide where we're going to go over, especially when we start talking about technical indicators in a few minutes. And another one is the top technical indicators explained, because we're going to look at a little presentation later about combining technical indicators into what we call a non-confluent trading system and how to build it into a trading strategy and make trading decisions. So I've explained them all to you in those handouts. If you click the little download button, you can download them to whatever device you're using at the moment. There's no password. There's nothing you have to do. They're free. They're for you. They're PDF files. And you can then look at them later, move them around to your other device, but they're only available in this live class. Now, back to our chart analysis. Price charts are also the reflection of all market participants' beliefs about the market and market variables. So by focusing your analysis and trading on a market's price chart, you can streamline your trading and at the same time analyze the results of everything that contributes to the price movement of a market. Now, many people try to make this overly complicated. If you think all you're trying to do is make a simple trading decision, do I want to enter the market or don't I want to enter the market? Is there an opportunity here? Because remember, your trading doesn't actually begin until you enter the game. The game doesn't start until you initiate a trade. So you can make it all complex and involved. But the fact is, you only make profit when you close a trade. When you open a trade, you're only putting yourself at risk. But you have to use some type of system or filtration to decide whether you can make a trade. Some traders make it so complicated, they have so much stuff on their charts that you get absolutely lost. And others just hastily make decisions. But by simply building yourself a small little trading system using a couple technical analysis tools like a trend line, a support and resistance line, and a chart pattern, you can have an easy system that tells you, yes, we have a trade. No, we don't have a trade. Because at that point, then you have to apply your risk management, decide if you can even afford to make that trade, and then your entry point. But that's all after you've decided whether you want to make a trade or not. Now, have you ever heard the adage, history tends to repeat itself? Well, technical analysis is a method of predicting price movements and future market trends by studying the previous and past chart action. Technical analysis is concerned with what has actually happened in the market. What did price do the last time it was at 119? The last time it was at 119, it climbed up as high as 120, but couldn't break 120, fell back down to 118. Well, that was last week. Last year, it did the same thing. The year before, it did the same thing. So what does that tell you? That 120 doesn't mean the price won't go past 120, but it tells you that 120 is a strategic important level. that you can expect something to happen. Either price is going to bounce off of it or price is going to bust through it. But you know you can expect something at 120. Well, if I had entered a trade and already have it going, where would I put my exit point, or where would I be looking to exit that trade? Right by that 120. If I had looked at a stock and every time I saw that stock, it never could get past that 120, and it might fall all the way down back to 96 and come back towards one. Well, I might say, if I see it bounce up the 120 level without any, support to make it move up, maybe I'll sell that stock. Maybe I'll enter the market on a short at that price. But it's based on historical significance. So one major advantage of technical analysis is that experienced analysts can follow many markets and market instruments simultaneously. And that's very nice because you see most technical analysis, like trend lines, support, aren't constantly being updated. Your support and resistance levels have been drawn on your charts and brought forward from the past. Your trend line is the current price trend is moving. If a triangle is developing, it's going to develop over a period of time. So you can have many different assets. So for instance, I only trade currencies. I don't trade stocks. For many years, I was a trader on the CBOD in Chicago many years ago before we even had computers to trade. And I only traded livestock then. Today, I only trade what? I trade the euro and its crosses, nothing else. Okay, but that still gives me lots of trading opportunities. So when we come down to technical analysis and analysis theory, we have a lot of categories. So we break down technical analysis into reading price charts, whether it's bar or candlesticks, understanding trends and trend lines, interpreting price patterns, indicators, and then we have number theory. So we've mentioned earlier waves, Elliott waves, Gann fans, Fibonacci levels. Okay, the most popular out of all that for our type of trading is fibs. We all tend to use Fibonacci retracements. We know what they are: 68, 2, 50, which actually is assumed to be a Fibonacci, but it really isn't. It's part of Dow theory. And then we have 38, 6. Okay, these are retracement numbers. We have indicators. We all know the popular RSI, stochastic, CCI, MACD, moving averages, okay, Bollinger Bands, indicators. We have some that are dropped right on price charts. We have others that are drawn below price charts. Then we've talked about price patterns. Those are what? Those are our triangles, our wedges, our pennants, our flags, our head and shoulders, our double tops and triple tops and double tops and double bottoms. Then we have trends and trend lines. Now, trends are generally the movement of the market. Remember when I said in the beginning, price is random. There's certain times that price exhibits non-random behavior, and those are trends. And we have to understand trends, because if you understand that it takes a lot of energy to build a trend and exactly how a trend should be going from a lower low to a higher low to a lower low to a higher high to lower low, higher high to lower high, and is making these push and ease as it moves up or down. This is a well-developed trend, and understanding how trends should work, because the more qualified the trend, the better our trading results will be. And then one of the first rule-based indicators that we add onto our chart is trend lines. Trend lines are really nice because they come with rules. So your trend line, the guy across the world's trend line, the guy down the street trend line, should all be relatively the same. And that tells you, when you can understand what price everybody else is looking at, then you can then figure out what price would be important to you. And then, of course, we have the simplest part of technical analysis, which is reading price charts. Candlesticks, which everybody loves, is the field of technical analysis. So reading charts, it gives us a pictorial price history. When you look at a chart and we go back, let's pop up a live chart here for you. When we look at a price chart and go back and back, what we're doing is we're getting a visual, pictorial, or graphic outlook of the history of price. And when we can see, like I mentioned to you before, when the euro had all this trouble at 119. Okay, now this was back several weeks ago. But we were to pull the euro forward, and the next time it moved up to the 118, look where it was able to go. That same high was that same range. Every time it's pushed up towards that 119, it's had trouble. When it's falling back down, we can look at levels, and what you see, all these red lines, green lines, dotted lines, these are my levels of support and resistance that I drew on charts a long time ago. And I've color keyed them for myself because they're part of my own understanding. But these are lines that tell me what levels or what prices should be important as the euro moves up and down. And these lines help us make trading decisions because they are historical lines. This tells us where traders in the past have hemmed and hawed in the movement of price, where price has gotten stuck. I mean, look how back to the 119 level again. But look when this is. This was a long time ago, okay, when this was important. So every time price has gotten in this range, okay, it's been gotten stuck there. So that helps us make current trading decisions. So price charts can give us a great pictorial history without looking at doing anything else from that point. So if the objective is to predict the future price, then it makes sense to focus on price movements. Price movements usually precede fundamental developments. So using charts help us see reactions prior to important levels. It gives us past and present volatility. It gives us historic volume or trading levels and relative strength of a security versus the overall market. It helps us with this entry points. And we have three types of charts. We have line charts, bar charts, and candlestick charts. Okay, we're not going to go over how to read the charts today because that's a class on charting. But we need to move forward a little bit because we want to get around to adding things onto our charts. Okay. So we've mentioned support and resistance, which you've seen I've added on the chart. We've mentioned trend lines. Okay. And there are many ways to use these on our charts. Okay. But they help us mark significant levels in the ladder or the climb of an asset when it's going up or the decline of an asset when it's coming down. Chart patterns also help us because what a chart pattern does, it tells us we don't care about the psychology of the market. We know as price moves closer and closer into the apex of this formation that eventually it's going to break out. We don't necessarily know whether it's going to break out upward or downward. Now, there's all types of reading the characteristics. I don't believe in them. I look for a pattern develop, and when price moves in that apex and gets really close together and I see volume decline, I'm waiting for that breakout. When it does break, I can then make trading decisions. So we have all types of these chart patterns. But the other thing about chart patterns is by measuring the width of the base of the triangle, we can actually project where the target point is. So this gives us, number one, a target point. This will give us an entry level after the breakout, and it will tell us where to set our stop loss. So we have the three important things we need. Then we can use the take profit point, the target point, the stop loss point, and the entry point, and calculate our risk reward ratio to see if we can even afford to make that trade. So chart patterns help us in all ways. But the most popular form of technical analysis is also moving averages, support and resistance trend lines, and momentum-based indicators. So what is a technical indicator? Well, remember this, indicators indicate. If you think of indicators, which are these complex mathematical formulas, or simple formulas like a moving average, what they are is they are your interpreters of what price is trying to tell you. So when you can't figure out what price is telling you, you can use these interpreters. So in other words, you're like the UN. Somebody's giving a speech. You can understand, you say you understand English quite well. Somebody's giving a speech in English, but they're actually from the UK, okay, or they're from South Africa, and you understand what they're saying, but the words are slightly different. And you need to still put your headset on because even though you understand the language, you need help with the fine innuendo. Well, this is what an indicator can do for you. They can help you translate or interpret the market. So remember, indicators indicate. So indicators serve three broad functions: to alert, to confirm, or to predict. An indicator can act as an alert to study price action a little more closely. If momentum is waning, it may be the signal to watch for a break of support. Alternatively, if there's a large positive divergence building, it may serve as an alert to watch for a resistance breakout. Indicators can be used to confirm other technical analysis tools. If there is a breakout on the price chart, a corresponding moving average crossover could serve to confirm that breakout. If a stock breaks support, a corresponding low on the on-balance volume could serve to confirm the weakness. So according to some investors and traders, indicators can be used to predict the direction of future prices. A technical indicator offers a different perspective from which to analyze price action. Some, such as moving averages, are derived from simple formulas, and the mechanics are relatively easy to understand. Others, such as stochastics, have complex formulas and require more study to fully understand and appreciate. Regardless of the complexity of formula, technical indicators can provide a unique perspective on the strength and the direction of the underlying price action. But keep in mind, again, indicators only indicate. This may sound straightforward, but sometimes traders ignore the price action of a security and focus solely on an indicator. Indicators filter price action with formulas. As such, they are derivatives and not direct reflections of price action. This should be taken into consideration when applying indicators. Now, again, as I mentioned earlier, when I say the technical analysis, too many traders automatically jump immediately to RSI stochastics, and they forget that that's only one small field of study. Of technical indicators, of technical analysis. So a lot of us build our entire trading systems based on technical indicators without even completely understanding the whole field. But technical indicators also break down into different types of indicators, because we have momentum indicators, we have volatility indicators, we have volume indicators, we have trend indicators. Okay. We have overbought and oversold indicators. And many traders swear by them to help with the timing of their trades and to alert them on trends. But even for an investor more focused on the underlying fundamentals of companies, learning how these indicators work can provide additional conviction on new or existing trades. So these technical indicators measure the direction and strength of a trend, such as moving averages are used to identify trends and reversals. MACD, moving average convergence and divergence, are parabolic stops. These technical indicators may identify the speed of price movement. Then we have others that tell us how volatile the markets are. And lastly, we have ones that tell us how volume is. I mean, if volume is low and a stock is moving up and the volume isn't changing or volume is falling, it tells you something isn't right there. Now, oscillators are the most reliable in periods when there is no clear trend in the market. Price is kind of moving sideways, narrow range. Oscillators help tell us when price is going to jump out of that sideways movement. So a lot of traders, like I said, swear by technical indicators, but they don't understand the differences, and they use technical indicators that are all telling you the same thing because they all use kind of the same formula. So what happens is a lot of them will say, I use RSI as stochastics. Well, these are both two indicators that use the same basis and give you the same information. So why wouldn't you use a trend indicator with a momentum indicator with a volatility indicator? And if all of those are supporting your decision, then maybe you've got something right. But technical analysts consider the market to be 80% psychological and 20% logical, where fundamental analysts consider the market to be 20% psychological and 80% logical. Psychological or logical may be open for debate, but there's no question that the current price of security, after all, it is available for all to see and nobody doubts its legitimacy. So the price set by the market reflects the sum knowledge of all participants. And we are not dealing with lightweights here. These participants have considered everything under the sun and settle on a price to buy or sell. These are the forces of supply and demand at work. By examining these price actions to determine which forces are prevailing, technical analysis focuses directly on the bottom line. What is price? Where has it been? And where is it going? So I'm going to share with you a little presentation I put together for you that's going to show you how you combine technical indicators and price to build a strategy and then make trading decisions. And then we'll go back and talk about some other ways that we can use this in our trading. So as you saw, we can combine technical indicators into a simplistic strategy that will help us determine when to enter the market and how to enter the market. So even though there are some universal principles and rules that can be applied, it must be remembered that technical analysis is more of an art form than a science. Now, just a reminder here, all of those indicators are in that handout I gave you and explained how to use them and what they indicate. So remember, click on those download buttons so that you can remember how all that was put together. However, it is also flexible in its approach, and each investor should only use that which suits his or her style. Developing a style takes time, effort, and dedication, but the rewards can be significant. So keep in mind that technical analysis is a very broad field. You can make it overly complicated, or you can make it simplistic. As I said, simply looking at candlestick charts is technical analysis. Looking at a triangle, looking at support and resistance, or using a simple indicator. The whole idea is we're trying to filter out bad trades. Okay? And we're trying to get a simple little system that will help us get into the market so we enter the game. But we also want to constantly manage our risk. And this is crucially what's important, is managing your risk. Okay. So one will tell you here's a trading opportunity. Managing a risk will tell you, I can't afford to make that trade because my potential profit is not covered by my potential risk. And what I'll do, you don't make the trade. But remember, risk management is ultimately what's important. Now, if you do have any questions, if you go to fbs.com and click on their live chat or send them an email, they will be glad to answer, or just go over to their education section. But remember what I said last, developing a style takes time, effort, and dedication, but the rewards can be significant. But don't jump in 2 feet first. Start out simple. Start out with one indicator that's interesting to you. Or start out with just triangles. Start out simple. Build onto it. You have years and years and years to create more involved systems. You have years to master all of these different tools that you have, but become proficient at one as you add the other. So again, thank you very much for joining us. Thank you for supporting FBS as well as Forex Live. Have a great trading day. And again, thank you very much. Bye now.